Imagine you are planting a tree. You don't just pay for the tree and leave it to grow on its own. You need to nurture it over time, providing water and care until it becomes strong and established. An amortizing loan is a bit like that nurturing process, but for borrowing money. Instead of paying back a loan all at once at the end, an amortizing loan is structured so you make regular payments over a set period. Each payment you make is carefully calculated to cover two things: the interest on the loan and a portion of the principal, which is the original amount you borrowed. Think of it like this: you're slowly but surely chipping away at the total amount you owe, like sculpting a statue from a block of stone, payment by payment. Initially, a larger chunk of each payment goes towards interest. This is because at the beginning of the loan, you owe more principal, and interest is calculated as a percentage of the outstanding principal. It's like the early stages of nurturing the tree, where you might focus more on watering and fertilizing to get it started. As you continue making payments, something interesting happens. The portion of your payment that goes towards interest gradually decreases, while the portion that goes towards the principal increases. It's a seesaw effect. This shift occurs because with each payment you are reducing the principal balance. Less principal means less interest is calculated for the next period. It's like the tree growing stronger. You can then focus less on initial nurturing and more on allowing it to grow and become self-sufficient. This gradual shift is the essence of amortization. It ensures that with each consistent payment you are not only covering the cost of borrowing the money, which is the interest, but also steadily reducing the actual amount you borrowed, the principal. This is different from, say, an interest-only loan, where you would only pay interest for a period, and then be faced with paying back the entire principal amount in one lump sum. Amortizing loans, in contrast, offer a much more manageable and predictable path to repayment. The beauty of an amortizing loan is its predictability. Because the payment schedule is set at the beginning, you know exactly how much you need to pay each period, whether it's monthly, quarterly, or annually, and for how long. This allows for better budgeting and financial planning. You can see the finish line, knowing that with each payment, you are getting closer to fully owning whatever the loan was used to purchase, be it a house, a car, or equipment for your business. Consider a mortgage, a very common example of an amortizing loan. When you buy a house with a mortgage, you're not expected to pay the entire house price up front. Instead, you borrow a significant portion from a bank or lender. The mortgage is structured as an amortizing loan. Your monthly mortgage payments cover both the interest on the loan and a portion of the principal. Over many years, as you consistently make these payments, you gradually reduce your debt and build equity in your home. Eventually, after making all the scheduled payments, you will have completely paid off the loan and own your house outright, free and clear. Similarly, car loans and many student loans are also typically amortizing loans. They provide a structured and predictable way to repay a significant debt over time, making large purchases more accessible and manageable for individuals and businesses. The consistent and gradual reduction of the principal is what makes amortizing loans a preferred method for borrowing and repaying money for many significant life purchases. It's a systematic approach to debt repayment, ensuring you're not just treading water with interest payments but actually making progress towards owning the asset you financed.